I'm joined now by my colleague Karen Manczko. Together we'll be discussing both markets and Wespath fund performance. Regular viewers might know we've talked about these two themes separately in past webinars. We've decided to combine these two segments together this quarter. We think the conversation should flow nicely and certainly welcome any feedback on themes to cover in future quarters. With that said, Karen, how did the first quarter treat you?
It's a great quarter for the markets and for our alma mater, the University of Illinois. For our fellow Illini fans and followers, the Illini made it to the Elite Eight in the NCAA tournament for the first time since my senior year at the University of Illinois, which was almost 20 years ago. Joe and I both attended the University of Illinois for our undergraduate degrees and obtained our MBAs from the university, which is why we are proudly supporting our alma mater as we give today's update.
It was certainly a quarter to remember for Illini fans, and as you mentioned briefly, it was also a quarter to remember for the markets. This was the best quarter since 2019, with 22 record highs for the S&P 500. You can see at this chart on the right, we've been looking for quite a run for the S&P 500 since October of last year. The S&P 500 was up 10% on the quarter, and the unexpected part was this happened even as the yield curve moved higher.
That is unexpected because the markets have been following the yield curve, and we have a chart to show this divergent. You can see that from this chart on the left that the S&P 500 moved higher even as rates moved higher, a clear change from the past several quarters. Also, the market's not pricing in higher earnings. So again, this is a new shift in paradigm. You can see this on the chart on the right.
Yeah, you can see that this post-COVID cycle is unique, and many of the past correlations are just not holding up. And we continue to work through the $6 trillion in liquidity and the impacts that we're still feeling today. So looking at equity market returns broadly, you can see that the large cap names, the 50 largest names, they continue to lead the market, but we're seeing the rest of the market playing catch up. So Karen, what are your thoughts?
So for the past year and a half, returns have been led by the mega cap stocks. And we all know this as the Magnificent Seven and their strong 2023. But in 2024, you can see that the S&P 500 and the mid-cap index were close to the Russell Top 50. And we use this index, the Top 50, to measure our mega cap weighting in our U.S. equity fund. Small caps, shown by the Russell 2000, lag the broader index, which is expected with expectations for higher rates, and this can really dampen those asset class returns.
And I'd add that international stocks, shown with the MSCI EAFE index, and emerging markets continue to lag the returns of the U.S., but to a lesser degree than previous quarters. And valuations in international markets remain significantly cheaper than in the U.S. So with that said, how did Wespath equity funds perform in Q1?
Let's start with the U.S. equity fund. Net of fees, we underperformed slightly due to, again, that underweight to mega cap stocks, given that the Russell Top 50 was one of the best performing asset classes. A contributor to the fund performance was stock selection by our active managers, specifically one of our managers, DGI, who had strong performance in the first quarter due to their stock selection. Tune in to the rest of this quarter's webinar, and you'll see an interview between DGI and our deputy CIO, Jahara. Private equity was a slight drag as expected because the public markets were higher. Exclusions were slightly positive as Boeing was down 26%.
So looking at the international equity fund, we underperformed by about 1.6%. And I was looking at the fund's performance and noticed that the last 3 years have been especially difficult for active managers. And our managers, particularly with growth names, have lagged the benchmark.
Yes, while the fund had positive for the quarter, we did lag the benchmark. Stock selection by our active managers was a detractor to the fund performance. Also, similar to the U.S. equity fund, private markets were a detractor given the strong public market and these valuations lag. It's also important to note that the fund's emerging market exposure, China in particular, was a drag. And they're roughly flat for the quarter and lagging for both the U.S. and developed markets.
So let's switch to fixed income. So we talked earlier about the shift higher in the yield curve, which was certainly unexpected in 2024. The Fed basically signaled that they're done hiking rates in the fall, and the markets were looking for a slowing economy and slowing inflation. How did that work out?
Well, the economy remains more resilient than expected. GDP grew at 3.2% for the fourth quarter of 2023, and the Atlanta Fed forecast 2.4% for 2024. Inflation remains stubbornly above the Fed's 2% target, which at an annual rate of 3.5% as of March, which was the highest it's been in 6 months. So since this number has not come down, the market continues to roll back Fed rate cut expectations. We've gone through from 7 rate cuts in January to just 1 or 2 now that's expected in 2024.
So with rising yield curves, we should expect lower bond returns. And I think that's exactly what we've seen. So looking at the broad bond returns, the U.S. aggregate was down about 78 basis points and the global aggregate by 1.5%. And the inflation-linked index was largely flat. But since high yield in emerging markets outperformed, I would assume that Wespath fixed income funds also outperformed.
Yes, Joe. The Wespath funds outperformed benchmarks for the first quarter. In the fixed income fund, we outperformed by 30 basis points and 1.5 percentage points over the past year. Our overweight to credit and high yield and underweight to treasuries was the main driver of the performance, along with strong issue selection by our active managers. The Inflation Protection Fund was slightly below its respective benchmark. The out-of-benchmark allocation to commodities was a contributor to the performance. The fund's non-dollar exposure, however, detracted as we saw the dollar strengthen in the first quarter relative to other currencies. So as we pull up to the multiple asset fund on this next chart, here we have the multiple asset fund composite versus a balanced fund peer comparison. You can see on the screen that the multiple asset fund performed how it performed relative to other balanced funds currently on the market.
So thank you for that, Karen. And we have some exciting announcements for our viewers, correct?
Yes, we do. As you and Lucas will cover in one of your sections, we recently announced that we will be launching our Social Values Choice suite of funds to our I-Series investors. So if you want to learn more about that, tune into your section with Lucas. And also there's some information on this slide.
All right, and I have one final topic for our viewers. This chart shows the returns at the end of a Fed hike cycle, as shown by JP Morgan. On the left, it shows data since 1980, what happens in the 12 months prior to the Fed rate hiking cycle, and then the following 24 months after. And you can see that the stock market usually starts to rally before the last Fed rate hike as the economy is improving. And with the exception of 1999 to 2000, the dot-com crash, markets largely are higher in the subsequent 2 years after the Fed rate hike. And on the right is the 10-year bond. And again, you can see that the following 2 years after a rate hike is done are generally positive for bond markets also.
So really to summarize for our audience, prior to market cycles, when the Fed has indeed done their hiking or increase in rates, then we can expect positive market returns.
So Karen, yes, we can always have an external shock, and historically markets will react well to the end of a Fed rate hike cycle. Time will tell if that pattern continues, but with that, I want to thank the viewers for tuning in. Please reach out to us with any questions.